What's up, team? I want to jump right into some thoughts on what is likely to happen after rate cuts, but really from more of a macro and currency perspective. I want to provide some thoughts, some counterpoints, as well as some key areas that I'm paying attention to and really thinking about in terms of what is likely to happen, the impact it's going to have globally. And I don't want to waste any time, so I'm going to jump right in. So, as always, thanks for joining. I've been in the markets for a long time. Well over 20 years. Started investing and trading in 2001, so I've been through a few cycles. I've seen a few things and really like to break this down easy. So, as I often do, I'm going to share this from a slide perspective. I think this is helpful in terms of people who maybe want to read things slower, reread it later on, have a deeper understanding of it. So, with that, I'm going to share my screen and we are going to jump right on in here. And while I do that, I just want to say thank you again, everybody, for joining. I always appreciate it. Okay, so here's what we're talking about, team. It's a post rate hike from a global perspective, right? So, we really want to think macro, but with a focus on the US, of course, here. So, look, as we know, before we do anything, we are expecting a rate hike in the near future here. It could be 25, it could be 50. But whatever the case is, there are some things that we should be aware of. What usually happens after a rate hike, they're generally good things. But we oftentimes only think about it from the perspective of the stock market. There's lots of other considerations. And a good investor and a good trader understands life isn't just about stocks, it's about the currency, the way things move, the way confidence is built into this. So, without further ado, let's jump on in. So, here's what typically happens after. I have to just move my picture a little bit so I can see it. After the Federal Reserve cuts interest rates, typically there are several what we're calling general outcomes that we see occur. Okay. This doesn't mean it's set in stone. It doesn't mean that it's always going to happen. And what it should really be is an indicator in your tool belt in terms of what is possibly likely to happen. And then you can use your own judgment in terms of the probability or the statistical anomalies that we might see instead of what we expect to see, right? So generally, when rates go down, this is pretty obvious, we have lower borrowing costs, right? Loans get cheaper for consumers and businesses. This encourages spending, investment, and refinancing. Certainly, this helps for people to go out and get mortgages, get cars, spend more on their credit cards, generally get their hands on debt. From a business perspective, this helps with things like growth, refinancing debts that they have on their balance sheet. This can help to increase stock prices, etc. It's kind of a wave that really affects lots of things. This is why we typically then see a boost to the stock market. Stock prices typically to often will rise as lower rates make equities more attractive than bonds. For those who don't know, this is really a simplified way of looking at things on purpose. Generally speaking, for many years in the realm of investing, the idea is you are investing some portion of your portfolio in stock, some portion in bonds. I know today, and for most people who watch on YouTube, you don't necessarily invest in bonds, but it's an important indicator from a business perspective, right? If rates for bonds are going down and you're not getting the rate of return comma, expect, comma, or desire, then you're going to look for stocks, and stocks are going to offer more of that risk return ratio. Now, from a currency perspective, which is really the theme here, generally speaking, this creates a weaker currency, right? And this is because a rate cut can lead to a weaker US dollar, making exports more competitive. This is the big land. This is where trillions of dollars are at play versus billions or millions on the market, right? So it's important to understand the currency perspective here, how this affects things, and what to think about there. I'm going to go into some detail on this. There's also, which is kind of interesting, an increase in inflation pressure. Now, you'd be saying, well, wait a minute, I thought the whole point was we have inflation under control, so we're going to cut rates. But even when you say that, you can see why that sort of doesn't make sense, right? Like, now that we have inflation where we want it, we're going to start cutting back. Once we start cutting, inevitably it creates some pressure that inflation could go back up, right? Doesn't mean it will, but there's pressure. So, of course, lower rates might boost demand, and that leads to higher inflation over time, right? See how this is a 1-2. This is why when they say things like they're trying to get to a specific inflation rate that they like from a Fed perspective, this is what they mean and why they play with the numbers. And then another big one I think is improved consumer confidence, right? Cheaper credit may increase consumer spending, which also, of course, supports economic growth. So these are very generalized ways of thinking about what happens after a rate cut. Now, I want to call this out here because it's extremely important to understand the macro. All of the above really depends on the overall economic environment of not just the US, but the macro, and also the timing. There's lots of things that can be going on at any given time, when they're done in the year, what else is happening, what we expect for earnings. Just be aware of those things. Excuse me. So let's think about this from a currency perspective, right? When the Federal Reserve cuts interest rates, the US dollar often weakens relative to other currencies. Here's why. And I want to share this. I spent a number of years in foreign exchange and FX trading. This is a space I actually studied in school quite a bit. Um, you have to really think about the fact that every country, and then of course there's blocks of countries like the euro, is going to have their own currency that at any given time might be varying in strength or weakness against another country's currency, right? So we have to be thinking in terms of when we're doing business overseas or collecting revenue overseas, what that exchange rate looks when it brings it back. A normal person in a normal life, you're not dealing with this a lot, but when we're thinking about the macro, it's extremely important. So this is why I really want to call this out because I don't see a lot of other folks talking about it, right? What we are thinking here at the macro is typically lower returns on US investments. So a rate cut reduces the yield on dollar-denominated assets like US bonds, making them less attractive to foreign investors. This can lead to reduced demand for the dollar. So when another country wants to buy bonds in the US and they wanted a 3% bond, they can only get a 2.75% bond. They might look to another country to buy bonds there, which helps to, of course, finance the government. There's also a consideration around capital outflows. Investors may and often do shift their money to countries offering higher interest rates, which further creates that downward pressure on the dollar. Okay. So, same kind of idea, right? When we're talking about that macro, that big bank, that commercial banking perspective, this is something we talk about all the time. And then, of course, there's a concern around increased money supply. Lower interest rates typically will stimulate borrowing and spending, which increasing helps to increase the supply of dollars in the economy. Bada bing, bada boom, which can weaken its value, right? The more of anything we have, the less demand there might be because the supply is so heavy, right? So we can follow the pieces here. And I just call this out here, right? A weaker dollar generally benefits exporters by making US goods cheaper abroad, but can also increase the cost of imports. So it's always a bit of a give and a take. It isn't always a one-to-one, but it's always a consideration. Now, here's a couple of counterpoints I want to call out because I don't think that was a totally fair take on that. I know it's my take, but I wanted to give you an opportunity to understand that I don't just think in terms of it's one way or the highway. My own counterpoints that I go through during my due diligence and thinking about my investment process is that the typical expectation that a rate cut weakens the US dollar can be counterpointed here, right? So some factors may actually strengthen the dollar or potentially limit the decline after a rate cut, right? So it's not always an absolute. It doesn't mean that it has to go down. It might go down more or less, or maybe not at all. So just to call a couple of things out here that I thought were really important, right? The global economic conditions are big, right? If other central banks are cutting rates or facing economic struggles, the US dollar can still remain strong as a safe haven currency, even with lower rates. I'm going to get into that in a few minutes. Market sentiment, right? If a rate cut boosts confidence in the overall US economy, foreign investment might, could, will increase, which further drives demand for the dollar despite lower yields, right? And then, of course, inflation expectations. If the rate cut is seen as preventing deflation or stimulating growth, it can support the dollar's strength. So when you look at all of those things, there's a lot of like, it could, it might, it may, but it's important to understand that this is a game of probabilities. So understanding the likelihood, what has happened in the past, how it could affect things today, those are things you got to be thinking about as a global investor. So all this said, global context and investor sentiment are key things to determining the dollar's behavior after we get these Fed cuts. So let's jump back to this idea of global cuts for a second, right? So global rate cuts are something we also are tracking in real time to understand, all right, well, what is everyone else doing? So, well, we know that the US Fed has signaled that it might start to cut rates. It could be 0.25 or 0.50. Several other central banks, such as Canada, Switzerland, and the European Central Bank, have already begun cutting rates due to weaker growth and softer inflation numbers, right? So these global rate cuts reflect varying economic conditions, and many central banks are facing lower inflationary pressure compared to the US. So the TLDR here is a lot of banks have already, in fact, started to cut. And that is an effort on their part to get ahead of things or get ahead of problems that they view as being inflationary, deflationary, concerning for their economy, et cetera, right? We can go into each of those and understand why they may have done it and to what degree they've done it. But it is important to understand we're not the first to the table to start cutting rates. It sort of makes sense that we're not doing it. The other big piece is consumer confidence, right? So US consumer confidence is still relatively positive. right? We're actually at a 6-month high as of August 2024. I'm making this early September, so that's the most recent data that I had. However, and there's a consideration here, confidence levels do vary significantly by income group. I don't know that this would be a big surprise to anyone watching this, but it's important when we think about anything to do with the consumer, we're breaking it out into categories that create a sense of realistic expectations or who's going to be doing the buying, spending, borrowing, etc. Right? So higher income consumers, think 100K plus, are generally pretty darn optimistic. Those earning less than 25K, sort of on the lower end of earnings, show much lower confidence. I don't think there's any surprises there. And that really is a good moment to say it's sort of a have and have nots conversation, right? I called it here reflecting the economic divide, but really it's a have and have nots situation where some people feel safer and others don't. That sort of is almost like a standard expectation. What I would say the data is telling us, though, and as you can see, I've got the names of the places I looked for information here. Consumers generally are uncertain about where stock prices and labor markets are likely to go, but they are less concerned about an imminent recession coming around the corner compared to what they were feeling in 2023. So I think that's actually pretty interesting, considering what's going on from a a political perspective, and just the general whipsawing of the markets as it is today. The last piece I want to touch on here, sort of a high level, is on debt levels, right? On the debt front, both consumer and business debt uh, is sort of elevated. Okay, there's nuance in that term, but it is to be expected because inflation has hammered the cost of everything. So if things cost more and you're borrowing money to buy them, it sort of is a 1 + 1 = 2 situation where, of course, it's going to be higher, and the rates are higher as well. So just to get some numbers in front of your eyes here, consumer debt in the US reached 17.7 trillion back in Q1 2024, and we're largely seeing this driven by credit card debt and auto loans, which is not great. It's not good news at all, okay? However, and this is really shocking actually, DTI or debt to income ratios are actually historically low at only around 0.75. So what this is telling us is that although debt does seem and is very high, consumers still do in fact have some capacity to take on some additional debt before, stress levels are really peaking. On the business side of this as well, there are higher borrowing costs, particularly with variable rate debt. Now, I want to talk about this for just a second because I've mentioned this in a few other videos and I've tweeted about this a few times. It's really important to understand when we're analyzing the micro, individual companies, balance sheets, cash flow statements, we're looking at the margin of these companies. I think it's a great time to understand that what they're paying today, they may be able to refinance into lower rates. Those lower rates will reflect in lower variable payments. Maybe they can pay things off sooner. Maybe they can borrow more to expand operations. Maybe they can get leaned up in their operations, or maybe they can just look for higher margin rates by reducing those interest rates. So there's a lot of reasons to look at both sides of this. This is why I wanted to really look at this as a counterpoint versus point conversation here. So just calling that out again. And what I would really say is like that combination of high consumer and business debt with positive and albeit cautious sentiment, it does create an environment where central banks will need to sort of be very, very careful in what they do when they adjust rates, right? What we don't want to see is a situation where we're hammering cuts and then have to whipsaw back up again. That's going to destroy consumer confidence. So really what I want to do is just sort of throw this out there to the world and say, look, when we're thinking about rate cuts, it's important to get our eyes beyond just the stock market. We have to understand how it affects borrowing, how it affects bonds, how it affects the FX markets, how it affects the dollar, how it affects consumer confidence and debt levels, how it affects things like margin on balance sheets. So this was a quick one. I hope you got some value from it. I really genuinely thank you for doing this. If you haven't, I would really appreciate a like, sub, and comment. I really do barely get any views on these, but I don't care about that. I just care that someone somewhere gets value from it, and I like doing them. What I would ask, if you watch till the end, just do me a solid favor. Can you just put, excuse me, macro debt in the comments? I just want to see who made it this far. Thank you so much, team. Really appreciate it. And what I would say too is don't be scared about complex topics as it relates to investing. If you have things that you would like me to cover, I would love for you to tell me. If it's really complex, that's okay. If it's really simple, that's great too. It can be a short video. But if there's something that you're interested in, a specific company, a specific sort of financial or economic point or some part of the economy that's confusing or how things work, just let me know. Happy to do it. Happy to break it down, and hopefully it's easy to understand. So with that, I appreciate everybody. Thank you so much. Have a good one.